Welcome to the Broken Pie Chart Podcast, episode 338. I'm your host, Derek Moore. Solo this week, lots to get to, though. Let's get right into it. The VIX Seasonality. So, who posted this? This is from Top Down Charts. I saw this via Twitter. And it's average daily level of the VIX. And it looks at it from January through December. And I already knew this, but I kind of reminded about this seeing the chart. What you typically see is in December, that's your lowest point for the VIX historically. And this is 1990 through 2024. And they've got one line that has everything and one line that has the data excluding 2008 and 2020. So you see if those are the only time periods that you're excluding, you're kind of seeing like, well, just in general, going back now since 1990, which is quite a while ago, you're looking at patterns here. And the pattern is it normally sort of dives in December. It hits a low, although December of 2018 certainly was a different picture. And then you start to see it rise. And you start to see it rise a little bit into, February and March. And then it comes down and it keeps coming down. And usually at the end of July, early August is when it sort of troughs. And seasonally, you see it start to rise August and start to rise as you get towards, October, end of October, early November is when it plateaus. But really, I would say, excluding 2008 and 2020, it's that beginning of October. Now, when you think about historically what markets do, a lot of people think about October because of the 1987 crash, but seasonally, August and maybe September especially tend to be, August and September tend to be the worst on average months. Doesn't mean that you should short right now. It doesn't mean you should sell everything and go away. It just means historically that's typically what happened. And so the reason I bring this up is a lot of people keep looking at valuation. They look at the VIX hit a new year low recently, as we made another all-time high. And I think it would be really easy. I think everyone's looking. So if you look at prognosticators and you look at people online, they're sort of armchair quarterbacking this. And they're trying to say, well, if your thesis is the market's overvalued, you're trying to come up with any reason to build your narrative, to support your narrative, even if it doesn't happen. And VIX seasonality is one of those things. What we see, remember, this is just an average daily level of the VIX. There have been years that September, October, the VIX went nowhere. It was very low. So not surprising I would point this, but I think it's important to give kind of the bull case and the bear case on a lot of this stuff. I'll talk about inflation and PPI in a second. But VIX, I think this is just another reminder of it doesn't mean to sell and go away. It just means if you are concerned, and I would say you should always be hedged, but that sort of goes back to the idea of buying and hedging. But VIX seasonality, something to take a look at. Here's the other thing. I saw this from, we're going to get into a couple things here, but I saw an interesting note from Bank of America, B of A, Global Investment Strategy, Global Financial Data. And we keep hearing about the concentration at the top of the market. And sure, you could make the case that absolutely, when you look at NVIDIA and Microsoft and Apple and some of those companies, over the last 20 years or so, certainly it's near the highest concentration. Doesn't mean it's bad. That's why you buy the index. So even if you have 7, 10 stocks that are really running, you own the index. Great. And the earnings per share, an aggregate of all of the earnings. They throw it all in a pot and you come up with the earnings per share. But the B of A data shows that railroads were worth 63% of the U.S. stock market in 1881. And according to their headline, the most dominant innovation sector ever. And it was railroads as a percent of U.S. market cap, 63% in 1981. They most certainly are not that. Of course, railroads were one of the great technological revolutions in business. And so naturally, you would expect to see there was a period when that was a big deal. The internet, is AI the next great technical revolution? I think so. I think it has the possibility of being that. But the point is, I mean, if you own stocks in 1881, did that mean, I don't know, that it was too high? I mean, imagine if you sold when it went to 30% or it went to 20%. You never know how high is too high or at the level that it's actually going to turn. And so I just bring this up because a lot of people are talking about, oh, I don't know, we've never had this much concentration. Yeah, we have. We really have, actually. Railroads in 1881. All right, should we talk be bullish or bearish? What should we do now? Well, let's just talk about some of the economic stuff. PPI came out, producer price index, and a lot of talk about it was hotter than normal. CPI seemed to be fine. According to the pundits on TV, the PPI was a little bit higher. Although I would tell you less food and energy and less the trade PPI component. And I know some of you are like, hey, well, sure, you're going to keep eliminating things to get rid of whatever to meet a narrative. I'm not. I'm just giving you the facts. It was about 0.4% and not much. Daniel LeCover. Oh, hang on. Let me get his name right. Sorry, Daniel LeCow had posted. Sorry, Daniel. I had posted something on Twitter. And a lot of people have been talking about, there's no chance the Fed raise rates or raise rates, maybe. No chance they cut rates, or it would be irresponsible for them to cut rates right now. Look, I don't know what the Fed's going to do. I think you could probably bring rates down to 3.5 and you'd be fine. And just leave it there for a while. And remember, the other case sort of on the rate cut side is just to say, why do you really need a rate cut? People want a rate cut, but do we need one? Well, that's debatable. But Daniel posted something that I think is very interesting, and it was September of 2024 and October of 2024, looking at where the CPI was. And the CPI was 0.2% month over month in September of 2024. There was a rate cut. 0.2% in October of 2024. There was a rate cut. July of 2025, 0.2, exactly the same. So why were the numbers okay? The data was fine by the Fed to do a rate cut back then, but not in July. All items less food and energy, 0.3%. September and October, both months, 0.3%, July of 2025. So I don't know. I mean, I guess it was fine back then, but not now. And some of this Fed talk or the reasoning behind doing something or not doing something, I just don't buy it. And it seems like they are, look, I've been critical of the Fed before, but I just don't think just say you don't want to raise rates or lower rates. Sorry. Say you don't want to lower rates, or say that, we're going to dig our heels in and not do it because people are asking us to. But to say that the data is turned, it's not really showing up there. And it's the same thing with them saying, well, we haven't seen inflation via tariffs yet, but it's coming big time. Remember, there were 29 out of 30 economists who said almost 100% probability we're going to have a recession in 2023. Never came. So economists are wrong all the time, as are stock market people as well. But it's just the data doesn't really match up. When you look at, there has been a lot of talk of stagflation. I'm not really sure why. Liz Ann Saunders at Schwab put something out from Arbor Data and Science, and this is story count mentions of stagflation from January of 2025 through August 8th of 2025, and it was 879. And to give you an idea, in April, or right around April 1st, it was close to, I don't know, I'm an eyeballing this, about 2,700. So 879 is not 2,700, but it is the highest amount of stories since going back to May. So there's some thesis out there, some feeling that stagflation is coming. Maybe because of the jobs revisions, or maybe because, I don't know. I mean, look, unemployment's still really low, but I don't know what you want me to tell you there. So let's go back to we talked about the CPI. What about the PPI? And PPI so the trade PPI is a little bit interesting. I will put a link in the show notes to the Richmond Fed, who had a piece. This is Jono Trekun. I don't know how to pronounce the name, but the Macro Minute, and this is September 5th of 2023. And they're talking about PPI final demand trade services. And I mean, basically the PPI margin, it's margin price. It's the current selling price minus the current acquisition price equals the margin price. And this was, I think, 2%, 2% month over month, I think, or I don't know. I mean, it's a little bit wonky. I'm not going to get into it on this during this broadcast or this podcast, but it seems to indicate that margins are actually pretty healthy. And these are, if you think about it, they're kind of, I don't know, these are retailers, wholesalers, and they got to get the stuff from the manufacturers. And then what they're doing is they're measuring the difference in what they pay for the stuff from, let's say, a manufacturer, and what they sell it to a customer for. So that's why I go back and I look at the PPI and I say, well, I think that the market essentially shrugged it off because the market is smart about these things. And it kind of looked and said, well, if you take out some of the stuff, here's an interesting one too. When you look at U.S. export price by end use all commodities year over year, ooh, that's a mouthful. The actual was 2.2%. The prior was 2.5. Revised 2.6, so revised up a little bit. The survey was 2.5. So it came in less than expected when you looked at something like that. We're just not seeing in some of the numbers. If we look at U.S. import price index by end use of all year over year, I mean, it was minus 0.2 was the survey. The actual is minus 0.2%. The prior was minus 0.2%. Like we're just not seeing it in the import prices. Meaning import prices, even with tariffs, it's not showing up yet. So I don't know what to tell you. And a lot of people say, well, we're definitely going to see it. You just wait. We're going to see it. It's just a matter of time. Maybe. But until we do, we don't. I haven't talked about shipping container rates in a while, and there's the spot shipping rates. And you look at this, and this is WCI Shanghai to Los Angeles container freight benchmark rate per 40-foot box. That's one of those containers that you see going on the big container ships, the really, really big ones. And according to, who is this by? This is from Bianco Research. Somebody posted this on Twitter. August 14th, the cost was $2,494. Shanghai to Los Angeles. July 11, 2024, the cost was $7,512. And in fact, in June, it was $5,914. So this moves around a little bit. I believe the spot rate is for like, hey, I need to ship something and I haven't prepaid, I haven't prearranged anything, just on the spot. Like, hey, I need to ship some stuff. So it's low. It's not as low as it was in 2023, but it's as low. I mean, it's kind of as low as it was in March, and it's before that, it's December of 23. So the bull case on this is, well, we're not seeing it transfuse itself or transmit itself into shipping cost, meaning, oh, who's taking, if tariffs are a big deal and they're going to cause a massive bout of inflation, and it may very well, but I think you got to wait and see the data. We're just not seeing it. We're not seeing shipping rates go up. And the bear case is shipping rates are down because demand is down. And some people say, well, look, I mean, a lot of the purchases were pulled forward and they stocked up, and maybe there's still inventory, but so far we're just not seeing it in container shipping prices. So then we kind of look at what else do we want to look at here? Yeah, Jeff Weniger had something out, and I'll quote him. Today may be a very good day to remind FinTwit that China's PPI has printed negative year over year for 34 consecutive reports in a row. Producer price inflation in that country is minus 3.6 year over year. It is extremely difficult for the US CPI to rise materially whenever China's PPI bleeds out like this. And he's got a chart, and he's got in one axis, he's got the China Producer Price Index, the PPI, the initial year over year, and then he's got the US CPI on another scale. And there is a correlation. When China's PPI spiked, our CPI spiked. And there's these different periods. So I think it's an interesting point. A lot of people worry about the quality of data coming out of China, and that's a fair comment, I think. But I don't know. I mean, I think Jeff's point is that, look, unless you have real inflation, PPI in China, it doesn't necessarily transmit to the US. And so it's something to keep an eye on. And it's one of the reasons why I like to look at different countries' numbers, because sometimes you can glean a little insights into those. So then let's come back to the stock market a little bit. And we know that earnings drive long-term performance of the market. If earnings are growing, if earnings estimates are growing, if the forward 12-month estimates are being revised higher, typically that means, unless the market re-rates on a multiple basis, over the long term, though, markets tend to follow that higher. This is from 314 Research. I think this is Warren Pies. Yep, it is. And he had a annual cycle chart, S&P Buybacks volume, and he's looking at the cycles, seasonality of buybacks. And one of these you could see is in late April, early May, corporate buybacks accounted for 8% of daily volume, which I find really interesting because a lot of times companies don't do a great job of buying back their own stock, meaning they tend to buy it near highs. And like 2008, there were generational buying opportunities, but a lot of companies were saving their cash, or maybe they didn't have cash because of all the, there were negative earnings actually in the S&P. So good for companies buying near the lows. And then you sort of look at the seasonality. So what is this? 2014 through 2024, rolling 5-day average percent of total daily volume seasonality. And then they've got a chart of 2025, 5-day average. And, what you find is that there is a seasonality to it. And what he's saying is seasonal buyback dry zone. And that tends to be, it looks like middle of August through, I'd say, middle of October, when the percent of volume related to buybacks declines. So 8% was kind of, if you can see, you can't see the chart, but you kind of look and you say, well, yeah, there was definitely a big push in April. What's interesting too is that April into May, seasonally, on average, it was, around 3%. That's kind of high there. So I bring this up because maybe this is the bear case, that companies have been doing buybacks this year, and we're about to run into an area where some of the marginal buying is going to drop off a little bit if this typical seasonality pattern plays out. I'll let you know when I know, but it's just something to think about. Now, a lot of people don't like buybacks. I argue that buybacks are fine. Buybacks are return of capital to investors. They could pay it as a dividend, sure, but they could also buy back their shares. And whether they pay for a dividend, do it as a dividend, do it as a buyback, buybacks are more flexible. Remember, if a company reduces their dividend by 50%, the stock is not going to take that well. But if a company announces buybacks, and maybe they do all the buybacks they've announced, or maybe they pull back buybacks, they're not necessarily going to get punished in the same way. But then the nice thing too for taxable investors is companies increasing their dividends, although they'll most of the time, quote unquote, but talk to your tax advisor, they're qualified dividends, which get a little different tax treatment than, let's say, some of the dividends from ETFs, which might be ordinary income. Again, I'm not giving you a tax lesson here. You can talk to your CPA about that. But a lot of investors would rather have the buybacks because then it means that if that helps increase the price of the shares or increase the earnings per share or the value per share of the remaining shares after they've been reduced, and net buybacks, meaning they didn't issue a bunch of stock to use a stock-based compensation and correspondingly bought back stock. And this is net buybacks. I mean, investors kind of say, well, all right, well, if I hold on to it and the stock keeps running and they're doing buybacks, my shares are, I'm being undiluted. You know, the opposite is when companies issue shares, they dilute existing shareholders. So, and they'll decide when to pay the tax. And they pay it as, you know, maybe it's long-term capital gains. So, all right, I mean, it's maybe there's more buybacks this year. I think when you look at the level of buybacks, and this was a chart from Bloomberg Finance LP and JP Morgan posted on IsabelNet. Okay, that's a lot, but that's where I got it from. S&P 500 announced buybacks. And this went back, it looks like, to 2013. And I get it. You had inflation adjusted dollars. Doesn't look like this is inflation adjusted, but we are at a more in a dollar value. It's north of 800 billion so far this year. And that is more than any other year going back to 2013 at this point in time. So kind of looking through, I mean, this is probably through mid-July, you know, what's been reported, maybe end of July. The one that is higher, so if they stop doing buybacks right now, 2018, and it looks like 2013? Maybe 2020. You know, some of these are a little bit difficult. It might be 2024, actually. There's a couple grays that are similar. So anyway, if they go on this trajectory, though, and they keep buying back shares, I mean, if they get over $1 trillion, then they will have exceeded on a full year basis whatever gray line I'm looking at the chart was previously at $1 trillion. 2018, which I'm pretty certain because it's a nice stark red and it's the key down at the bottom of the chart is telling me it's 2018. It looks like they stopped, I don't know, not quite at 900 billion, but somewhere around there. So looks, I mean, buybacks can help the market. So certainly that's helped this year. And buybacks, I think, are an efficient return of, I mean, it's, to me, a company can issue dividends, they can buy back their debt, they can buy back their shares, they could invest it. And somebody might say, well, the company couldn't find anything to do with the money. Well, I'd rather they return it to shareholders than just do an investment just to do an investment. So something to watch for on the seasonality. And the reason why that is, it's interesting because you have that seasonality, but then we just talked about how the seasonality of the VIX has sometimes that August, September, towards the beginning of October, starts to rise again and then before falling. So maybe it's related to those two seasonalities. We'll see. I'll let you know when I know. And that's why we buy and we hedge. If you want to find out more about that or just want me to read a listener question, go ahead and hit me up at derek.moore@zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple, Investments is up to you to spell correctly.com. All right, couple odds and ends, and then we will wrap up. Bitcoin and MicroStrategies. So this is from Trend Labs. And what they did was they taking the ratio of MSTR, which is, I guess, strategy now, but MicroStrategies, I still call them that, divided by IBIT, which is the BlackRock Bitcoin ETF. So you take MicroStrategy divided by that. So let's say if MicroStrategy was trading at 500 and IBIT was trading at 100, then 500 divided by 100 is 5. So that would sort of be your ratio. Well, the ratio topped out almost 9 in November of 2024. And this year, I mean, the high was maybe right around 7.25, sometime towards the end of March. Well, we just hit a new 4-month low, and it's roughly, 5.7, 5.5, something like that. So what does this mean? Well, it means that, I don't know, maybe investors are not willing to pay as much of a premium for MicroStrategies as they are just for versus Bitcoin. Now, remember, I've got to do a whole episode where I break down, because I've gotten a lot of questions on what MicroStrategy is doing. I have a lot of thoughts on it. I think there's some misunderstanding about what they're doing, and I'm not tipping my hand whether it's good or bad. I'm just saying, when you're buying MicroStrategies, you could buy Bitcoin, or you could pay like 1.2 times the price of Bitcoin or 1.3 times the price of Bitcoin for the Bitcoin that MicroStrategies is holding. So I think was it Jim Chanos? I think it might be Jim Chanos. I have to double check. But he has this thesis that he says, hey, he compares MicroStrategy to some of the old line, the investment companies. I think it was him. I'm sorry, Jim Janos, if it wasn't you. But they comparing them to the investment companies of the late 20s, early 30s that use leverage and things like that. So anyway, maybe I'll do a whole episode on that, just to because I've been getting listener questions, so I kind of owe you, the audience, that. All right, finally, the question of the Fed can't cut, and I don't know whether they will or not, right? I mean, who knows? It seems like, as I said, the data is there to support a cut if they wanted to. I mean, they're going to do what they're going to do. They're going to meet in Jackson Hole and go on a ranch and talk about interest rates soon too. So I'm sure we'll have a lot of news from them then. But yeah, I mean, the Fed has cut near all-time highs. And this is from Ryan Dietrich on Twitter. And the bulls love it, he says. S&P returns after Fed cuts within 2% of an all-time high. And you look at going back to 1980, is the market up 1 year later? And there's 1 year, like 1989, it was up 2.6% the next year, but it was still up. We don't know about the cut in September of 2024. We don't know about the cut on November 7th of 2024. But I mean, 100% of the time, going back to 1980, when the Fed cut within 2% of an all-time high, the market has been up historically. Does it mean it would be up if they do it next time and at the next meeting a year later? I mean, who knows, right? But this thought that, why would they cut with the market all the time? Yeah, they've done it. Sure, they've done it. 1990, they did it. July 6th of 1995. Those of you who listen for a while know I've got this interesting correlation between 94, 95 and this current period that we're in from an interest rate perspective, 24, 25, 23, 24, 25. So yeah, I mean, of course they've done it, and they've done it multiple times. So I don't know. I don't know why some pundits and economists kind of are like, hey, they would never cut all time highs. Yeah, of course they've done it. They've done it. So, all right. So we talked about VIX seasonality, PPI. a bunch of stuff there, and I think my message continues to be, so far we haven't seen it come up in the data. Goldman Sachs, well, I mean, they put out some reports or some prognostications that they feel like the transmission is going to wind up in prices soon. It's just a delaying effect. And I thought it was interesting, the railroads once were 63% of the stock market. So yeah, maybe tech being, the Mag 7, the top 10 being this high of a percentage in the markets, not that crazy. Or maybe it is. I'll let you know. All right. Recommendations this week. So I watched a documentary on Netflix. I don't know why I started watching it. It's like 3 episodes though, on The Biggest Loser. And those of you who remember when that was big, I didn't realize it was on, they said 17 years. I don't know if it was 17 seasons where they did 2 a year, kind of like Survivor does, or whether it was actually 17 years, because I probably stopped watching it. But those of you who remember it, that was a huge show. So they kind of had some contestants, some of the winners who had, dropped all the weight, and they kind of caught up with them. And it's, so I don't know if I'd really recommend it. I'm just, no, I'm giving it a sell recommendation, to be honest with you. But it was somewhat entertaining. I was on a plane, I was watching it. The other thing I started to watch is there's an Apple TV Plus show, and it's got Owen Wilson, and it's called Stick. So he's a washed up golfer who finds maybe a new prodigy to teach. And I'm through 2 episodes, kind of entertaining. Owen Wilson's doing the character from You, Me, and Dupree. So if you like You, Me, and Dupree, it's kind of that same character. But yeah, I mean, that's what I watched. I was on a plane recently and watched some of that. And so far I'm encouraged by Stick. So I would give that a pending or a temporary buy recommendation. So that's on Apple TV Plus. All right. Plenty more to talk about next week, and appreciate the people who email. Remember, derek.moore@zegainvestments.com. Send listener questions. We've got to do a show soon with some listener questions. So go ahead and send your questions. Love to read those out. And by the way, if you have a second, refer the program to someone that a friend of yours, maybe someone who's not a friend, just some stranger. You just kind of go up to them and say, hey, maybe you should listen to this. And 5 stars only. Apparently, I'm supposed to ask you that. That's what people tell me in the podcasting world. I should ask you to rate the podcast 5 stars. And if you're not going to rate it 5 stars, don't bother, because I guess like 5 or nothing apparently matters. All right, do what you want though. Just listen, buy and hedge, and we'll talk to you next week. Take care.